Let's talk about Tesla, because Tesla shares for the year to date are up 80%, but for the 1 year period, they're still down 35%. This is a stock that's gone from $381 to $108 and back up over the last year. That is a lot of volatility.
Yeah. I'm not looking to make money tomorrow. Yeah. I'm looking to make money I want to double my money every 4 or 5 or 6 years. The way I think about it is I want to find companies, which we'll talk about a bit, about their competitively advantage. There's something about those businesses that makes it very difficult for other people to compete against them. That's what I'm looking for. I'm looking for amazing people running these people, awesome people, sometimes some people call them, great people running these companies, and competitively advantaged. It means other people cannot compete against them easily, and therefore they have an opportunity to price better and give better services and become much bigger than they are now. Tesla is a good example of that.
In this video, billionaire investor Ron Barron shares his thoughts on the economy, inflation, investing for the long term, the finance media, and of course Tesla, the company, and Tesla stock, which he believes is going to $1,500 per share. If you'll excuse me. athleticgreens.com/SMR. I'm a big fan of Ron Barron. The guy seems to get it. He has an extensive multi-decade track record of successful investing, which very few others can say. And he manages to identify opportunities that many other investors completely miss. I also don't mind the fact that he occasionally seems to accidentally leak confidential information from private discussions he may or may not have had with Elon Musk and or the team at Tesla. So as we can see, Tesla stocks had an extremely quiet start to 2023, up 1.05% year to date. Oh, that was today. My bad. Up 82.06% year to date. And what are we now? Early February. I'm sure it's nothing. Now, look, I just want to take a quick moment to own up for a massive mistake, an error of judgment. Previously, when others were panic selling Tesla stock near 2-year lows just over $100 per share, I continued to think for myself. And rather than panicking and dumping my stock as others were doing, I actually continued to buy the stock. That was a terrible mistake, and I should definitely have done what everybody else was doing to get the results that everybody else was getting. It's always a good strategy. Don't think for yourself, just do what everyone else is doing. In fact, don't think at all, emote instead. That is how to invest. You'll definitely make excellent returns for the people buying the shit you're dumping near 2-year lows. Of course, I'm not trying to single anyone out in particular. I'm just trying to point out what not to do, unless, of course, what you want to do is to embarrass yourself. I wonder if Ron Barron panic sold Tesla stock near 2-year lows. Let's find out.
So let's talk a little bit about what's happening with inflation, what's happening with the economy. As an investor, how you kind of add all of that up and figure out how things go from here.
So every morning, 6 to 7 o'clock, I work out and I watch you on television. And it's really entertaining for me. It doesn't make me change how I invest.
So we're only a few seconds into this interview with Ron Barron, but notice already what's happened. Ron has mentioned he watches CNBC in the morning while he's working out. So he's really working out and then doing something rather than nothing. So keep that in mind. He's not dedicating an hour of his day to watching CNBC. He just so happens to have it on while he's working out. But more importantly than that, he mentions immediately that it is entertaining, as opposed to, say, informative or useful. And then also mentions that it doesn't actually change the way he invests, because the way that you'd invest if you were following what CNBC are doing is short-term trading, stocks astrology, shorting Tesla stock for the last half decade or more. So right off the bat, Ron's basically said, look, CNBC is lighthearted entertainment and offers some fairly clown-like investment advice, but I still watch it. Of course, he said it a lot more delicately than that, but just reading between the lines here. Maybe I'm misinterpreting. Let me know in the comments below. What do you think Ron meant by that?
But it is very entertaining, and it's nice to see the service you're providing to people and how it makes them aware of why stocks are going up and down in the short term.
Again, a few seconds later, he's reiterated it's entertaining and also pointing out once again the extremely short-term nature. Keeping in mind, Ron is an investor, not a gambler. Therefore, he's a long-term investor, not a short-term trader. I mean, these fucking idiots literally have a segment called Fast Money. There's literally a show on CNBC called Fast Money. It says everything you need to know. And this is the difference between short-term gamblers who play in the stocks casino and somebody like Ron Barron who invests over the long term and as a result accrues substantial wealth rather than making some pocket change. The reason I'm hammering this point home so much is because we recently got to see a great example of what happens when A, you think you're an investor but you're not, you're a gambler. B, you don't actually have a long-term investment horizon. You have are we scared? Okay, forget everything I thought. No, abandon my investment thesis. No, I'm scared. I'm going to sell. I don't know how else to say it. Fear causes brain damage, at least in some particular people. This is why it's so important to A, have an investment thesis, know why you're investing, and B, a long-term perspective. Otherwise, you too may do something extremely embarrassing, like selling Tesla stock near 2-year lows. Nothing wrong with selling an asset, but there is something wrong with panicking and forgetting your investment thesis in the first place and getting overcome by your emotions, which can cloud your judgment.
And so the big picture I take away is that I started Barron Capital in 1982. And since then, there's been 1 year where the news was good. 1 year, 1989. That was the year where they took down the wall between East and West Berlin, and we thought there was going to be a peace dividend and everything's going to be fine. 1 year. And all the other years, we have pandemics and wars and inflation and panics and crashes, everything.
So we just heard from Ron Barron there, where over the last 4 decades, yes, literally 4 decades, count them. There's been 1 year where there wasn't a torrent of bad news. 1 year where people weren't fearful, panicking, worried, uncertain, experiencing doubt about at least 1 or 2 major issues. In other words, it's common for the shit to hit the fan. It's common for panic, fear, uncertainty, and doubt. It's common for fear-induced brain damage within the stock market. This is par for the course. It happens more often than not. Yet somehow, despite the world ending every single year out of the last 40 except one, somehow Ron has managed to not panic sell incredible assets and instead just held on to them and made literally billions of dollars. Is there a lesson in this? Can we learn something from Ron Barron and his long-term investment horizon and his willingness to ignore the noise and focus on the prize and his investment thesis? Could we possibly learn something from this wise billionaire investor?
And what happens? The stock market is 800 when we start, and it's now 33,000. So 41 times. We've done much better than that, but 41 times in the face of all this terrible, terrible news. And so I watch every day, and what it reminds me of is when I was in 8th grade, I was at Wanamassa Grammar School, where there were 3,000 people in the community, and Asbury Park had 25,000 people. And so we were graduating from Wanamassa, where we had 40 kids in our class, 2 classes of 20, going into Asbury Park High School, where there's 2,000 kids, 500 kids in a class. And the teacher tells us, the guidance counselor comes in to give us a lecture. And when the guidance counselor says, his name, and my friend Alan Levine, whose curveball I could never hit when I was playing ball, I never could hit it. Anyway, so call Alan, and he says, yeah, I remember it also. What I remember is that the lecture he gives us is that believe nothing that you hear and half of what you see.
I fucking love this. Words to live by. For some reason, the last couple of years is coming to mind. Believe nothing that you hear or are told, and only half of what you see. Wise words.
Nothing that you hear and half of what you see. I said, Alan, do you remember that? He says, yeah, he was my homeroom teacher. I remember that. And so that's the whole point. So imagine that when I'm in 8th grade, that's the thing that sticks in my head.
So don't worry about the headlines.
Yes.
So you're not worried about inflation, concerns about the potential for war, geopolitical issues with China, with Ukraine and Russia, any of those things at this point? You're just looking at what?
I believe that inflation will always persist and always has persisted, and it's a very large part of our economic model. So I think that inflation long-term is 4 or 5% a year. That's what you got to think about, 4 or 5% a year. That means that everything doubles in price every 14 or 15 years. Everything. It's tuition, it's labor, it's minimum wage, it's your car, it's your house, everything. And one of the good examples I have is, I gave a whole bunch of examples in a chart, but you guys couldn't figure out how to show it as a chart. But one of them is my parents. I'm born in 1943. And my parents bought their first house, and we lived in a garage, on top of a garage in Bradley Beach. And then we bought our first house in 1948, 5 years later, and it was for $5,000 in Wanamassa. And then and we had that till 1955 when my parents sold it for $10,000, and they bought a $20,000 house, which is sold for $150,000. 10, 15, 20 years later. The bottom line is, I looked up on the internet what this house is worth. This house at 1122 Grassmere Avenue in Wanamassa, $529,000. So 100 times. That's 6.1% a year. And if I looked at the other house that they had, which was for $20,000, which is now worth $1 million something, that house is 5.1% a year. Everything you look at, state, tuition, cars, everything, 4 or 5% a year.
The dude's right. Inflation is a big part of my own investment thesis as well. In my early 20s, I did the math. I went through this exact same exercise. I looked historically at the price of real estate in Australia, rental growth in terms of rental inflation. I did the numbers and realized I'd have to be a moron not to buy a piece of real estate as soon as possible. Because my salary was likely to increase a lot slower than the actual value of the asset, the real estate I'd either purchased or failed to purchase. And over time, although mortgage repayments would be higher than rental payments initially, that would actually switch. And then in the future, I'd be paying off a mortgage for less than it would be costing me to rent a place. And by the way, just for the record, I actually currently rent. It might sound a little bit hypocritical, but I still own all the real estate. So I'm still benefiting from that appreciation. And it is my tenants who are now subsidizing my own rental expense. As it goes up, I also have a number of tenants whose rent is going up over time as well. It's important to understand this. One of the amazing things about locking in a fixed amount of debt, e.g. a mortgage, is that over time, over the decades, it's effectively eroded due to inflation. You continue to owe the same amount of money to a lender, even if you don't pay it down, even if you're just paying interest only. You still owe the same dollar amount, but the real buying power of those dollars is significantly less. If there were some people out there who'd purchased real estate maybe 100 plus years ago, e.g. the example Ron Barron gave there of purchasing a house for $5,000, if the owner of that house still had a mortgage today, they'd be paying less per year in mortgage repayments than the average household spends buying eggs per year. That is the power of inflation.
But if you are looking at a year like this, where we have seen extraordinary inflation over the last year or two, and where you are watching the Fed as a result try and slam the brakes on that inflation by raising rates, it does change the investing picture over the shorter term. If you're not looking 20, 30, 40 years down the road, if you have a shorter time frame, what we've seen is the growth stocks have gotten crushed and value stocks have become more valuable.
Completely.
Poor CNBS just can't help but bring the conversation back to the short term. Now look, in fairness, if my brain were bigger, in fact, if my brain were big enough that you could officially call me a genius, I might think I was smart enough to time the market and I'd be trading in and out of stocks, paying my capital gains tax, ending up with less capital, redeploying it somewhere else and getting a much bigger return. I could have sold Tesla stock at $400 and bought back at $101 per share. Unfortunately, I'm not a genius, and I recognize that I'm not that smart. My brain's not that big, so I just choose to buy, hold, and look to the long term.
One thing that's interesting to me, so now it's early, I started Barron Capital in 1982. Now it's the early 1980s, I get a phone call, it's Ken Langone, and he says, do you know who I am? I said, everybody knows who you are. Why are you calling me? He says, I want to meet you. And so I say, so what do you want to do? Meet me at the Waldorf Astoria at the Bull and Bear restaurant. I want to take you to lunch. So we have lunch. And he tells me that he is buying for himself a company called Daylin, D-A-Y-L-I-N, which is a company emerging from bankruptcy. And they have one really cool business called Handy Dan. It's a home retailer in California run by Arthur Blank and Bernie
Marcus.
Bernie Marcus.
Yeah.
And so I meet these guys and I like them. And I've been investing in it on behalf of my clients. He's investing in it on behalf of himself. And so I'm making commissions. That's how I'm living. I'm living on commissions, not fees. And so he says to me, you know, we're just banging our heads against each other. Why don't we split the shares? Whatever I see, I'll give you half. Whatever you see, you give me half. We don't compete against each other. I said, that's fine. That sounds like a great idea. Then he puts his arm around me and he says, guys like us, he went to Bucknell like I did. He says, guys like us, we got to stick together. I looked around to see if there's anyone else he's talking to. Guys like us? What is he talking about? Anyway, so the bottom line is that I doubled or tripled my money in Daylin because of this Handy Dan, and then he stayed with it, and then he ultimately financed Blank and Marcus to build Home Depot. Because I had a short-term focus and made 2 or 3 times my money, and he stayed with it, he got to invest in Home Depot, and I didn't, and at the beginning. And so he made this giant fortune, not worried about short term, but thinking that these are great people, I want to back them.
So you don't worry, you don't change your investing focus, anything that's happened over the last couple of years?
No.
You stick with it?
Yes.
Let me translate that question from Becky to Ron. Hey Ron, so you're telling me you decided to rely upon the wisdom you've gained over the last 40 years and not suddenly out of absolutely nowhere disregard everything you've learned in the last 4 decades and start making short-term decisions, take your eyes off the prize, become fearful, panicky, and overcome by emotions like everyone else did? You're telling us you didn't disregard your 4 decades of wisdom, Ron? Why not, Ron? You were supposed to panic like we were. Didn't you know? Rates are going up. That means sell growth stocks. Didn't you know? Why didn't you panic, Ron? You're supposed to panic. Don't you know that? You're meant to panic.
Let me ask you separate. When you look at like a Home Depot, a lot of or even Tesla, you were early, very early in this early sort of stages of these companies. There's a lot of companies now, I'm thinking big tech, for example, where the prices come down remarkably because of where we are in the cycle. And a lot of people who own those stocks and have held on. Is there an argument to be made, given where the prices are now, that you say to yourself, okay, if you're a really long-term player, these are actually very attractive prices, or is that a completely different sort of way to think about it? The kinds of companies that you would otherwise invest in.
The way I think about it is I want to find companies, which we'll talk about a bit, about their competitively advantaged. There's something about those businesses that makes it very difficult for other people to compete against them. That's what I'm looking for. I'm looking for amazing people running these people, awesome people, sometimes some people call them, great people running these companies, and competitively advantaged. It means other people cannot compete against them easily, and therefore they have an opportunity to price better and give better services and become much bigger than they are now. Tesla is a good example of that. I'll get to Tesla, but I mean, that's what we're doing. And I'm not really worried about the stock market. I don't worry about the market, don't worry about the economy. I listen to all these guys talking about interest rates going to 5.4%. I don't care.
But Ron, why didn't you panic? You're supposed to panic. Don't you understand if rates are going up, you have to sell growth stocks, you have to buy value stocks? That's how it works, Ron. Don't you understand if rates are going up, you have to panic and sell growth stocks, Ron? This guy's so dumb. It's not like this guy has 4 decades of investing experience. Doesn't Ron understand that if you happen to own the stock of a company who's going after multi-trillion-dollar opportunities across a broad range of industries, has an unassailable lead, incredible talent, world-class leadership, and so on? Don't you understand that if there's a recession or interest rates are going up, you have to sell that asset because the world is ending? Can you believe this guy? I don't think he sold his Tesla stock despite the fact that we know that during a recession, automotive sales go down, therefore Tesla's going bankrupt. This guy's so dumb. I don't even know why they have him on as a guest.
But I guess my question is, you're trying to, for the most part, find companies early on in the process, not necessarily pre-IPO, though in some cases pre-IPO, but are you looking at companies that have been around 20, 30 years and looking at a valuation ever and saying, you know what, that seems that it's like mispriced to me? Well, or by then you would already know that it's not on your list.
I have a mix of companies. And so I invest in people like Tom Pritzker. And so Hyatt, we invested in Hyatt, and Jay, his dad, was one of the first people to help me when I came to Wall Street in the early 1970s. And so that business around, I actually invested in Hyatt when it was a public company before it went private. And I argued against him for bringing it private because I thought my shareholders weren't going to do well by him going private. And of course I was right. But I'm friendly with his son, Tom, since 1979. Love Tom. Investing in Hyatt. It's a mispriced company in the stock market. The stock market is valuing the company 11 or 12 times, and the private transactions are 17 times. And plus, you've got spectacular people running the business. So, yeah, I look at mispriced things. But the reason we've done better than most, I think, is because we're not all just pedal to the metal, straight ahead. And the idea is that we have some companies that can grow really, really fast, and some companies that are based on book value or based on revenues that we can, consistently give us a base that allow us to take some chance in some companies like a Tesla or a SpaceX. Or FIGs.
What's that?
Or FIGs, for example.
Or FIGs.
Yeah.
But again, to Andrew's point, most of these are ones that you find pretty early on.
Yes.
You're not looking like maybe an average investor would be looking at these things.
I'm not looking to make money tomorrow.
It's been my observation that, in general, those who are looking to make money tomorrow typically find themselves parting way with their money tomorrow. Let's move on.
I'm looking to make money I want to double my money every 4, 5, or 6 years. And so right now, we had a tough year last year. I think it's going to take us till the end of 24 to get back to where we were in October of 21.
Assets under management fell from $48 billion to about $39.3 billion now. Is that right?
$57 billion to right now it's $40.6 billion.
Okay. So that was because you're invested in a lot of stocks that are...
that went down.
Yeah, that went down sharply because they're high-growth stocks. Again, is it hard to hold your conviction? You are somebody who holds on to stocks for a long time, but how much tougher does it get?
If I was worried about stock prices, they'd be very hard. And the only way you can possibly be a long-term investor in a business is by you knowing more about the business than anyone else and having conviction in the competitive advantage of that business compared to other people that you're competing against.
Hope you were taking notes. If not, rewind 1 minute and listen to that again.
Let's talk about Tesla, because Tesla shares for the year to date are up 80%, but for the 1 year period, they're still down 35%. This is a stock that's gone from $381 to $108 and back up over the last year. That is a lot of volatility.
Yeah.
It's been a ride.
I agree with that. So before we get deep into Tesla, I want to just make two comments about, number one, how it's the safest car that's ever been built in the world. The safest car ever built in the world. And about a week ago, or 2 weeks ago, or 3 weeks ago, there was a man who took his wife and 2 children, 2 daughters, and drove it off a cliff 250 feet above the ground, and at 71 miles an hour. he was trying to commit suicide and murder at the same time. The car flies off the cliff and tumbles down to the bottom, and the roof on a Tesla is 30 or 40% stronger than any other roof, and the center of gravity is the middle of the car instead of the front of the car. And it rolls down to the bottom of the hill, and everyone's looking down, and then they lower people down, and they open the doors, and people just sitting there. They were fine. They were unscathed.
But unbelievable that they got out and were able to.
So unhurt. And so I told Elon he has to text about this and tell people that if they want to commit suicide, they should not be driving a Tesla. They should drive, a Bentley. Drive a Bentley, drive it up the cliff, you'll die. Don't do it in a Tesla. So number one, the safest car for them to build. And of course he tweeted about that. Number two, Toyota. So Michael Barron, my son, and I went to visit Toyota in Japan a couple months ago. And we were meeting with an executive, and we had a translator with us because we don't speak Japanese. That guy did speak English. And so we started asking him questions. And initially, it starts off, he's responding in answering my questions in English. And then all of a sudden, he switches to Japanese. And it happens every time there's a tougher question. He starts off with English and then goes to Japanese. And I finally say, listen, I can't have a conversation with you when you have a translator and I'm listening to this translator. I got to talk to you in English. And so it was nothing. And then we walk out, and this whole strategy behind Toyota was they are negative about electric cars. Right. And what he wanted to do, he says, we want to have the lowest cost of mobility in the whole world. And so the result of that, rich people, they can plug in their cars. If you're a lot of places, there's not electricity, so you can't plug it in. So we're not into that. That was what we took away. So we walk out, and I said, Michael, I don't understand any strategy that they have here. This reminds me sort of of Sony in the 1970s. They're just stuck in their ways. But I don't know. We never heard the strategy. And he said, Dad, I've never been more bullish about Tesla. And what do you know? The head of Toyota just retired yesterday or the day before, last week. He's the grandson of the founder. And he says, I'm too old for doing this. He was 65. I'm 79. So basically, he says, I'm too old for doing this. The bottom line is that the head of Volkswagen gets fired. The head of Ford, Mark Field, gets fired because they had bad strategies, bad people. And Mark Field came to visit me a few years ago. You couldn't believe the negative things he's told me about Elon Musk. All wrong. And just, he had a bad strategy, not a great executive. Okay, I shouldn't say that. All right, good guy.
Well, he did say that, so there you go. Apparently Ford's ex-CEO had bought some FUD about Elon Musk. The whole thing, down the throat. Didn't even gag. Elon bad, because I read it on the internet. So, are there any lessons we can learn from today's video, hearing from Ron Barron with more than 4 decades of investing experience? I think so. Number 1, know why the you're investing in a company in the first place. Continue to use your brain, even when others cease to use theirs. 3, don't get swept up in groupthink, herd mentality, or an emotional tidal wave of panic when it sweeps through the markets, whether there's a recession, whether there's a plague, whether it's the end of the world, whether we're on the cusp of World War III, because there's always something. Every year, well, all but one of the last 40, it was the end of the world in one way or another, yet still somehow Ron Barron managed to invest and produce returns that absolutely crushed the overall indices. It's almost as if conviction, a strong thesis, and avoiding emotionally induced brain damage is a good strategy for long-term investing. Alternatively, you could ignore Ron Barron's wisdom and panic sell Tesla stock near 2-year lows. And look, I don't want to be too hard on the people who suffered from fear-induced brain damage and made catastrophic financial decisions in the recent months because, hey, nobody's perfect and you're probably suffering from a half-functional brain, fatigue, lethargy, lack of energy, poor gut health affecting your mood, bad sleep, you name it. Not your fault. Life's hard. I'm a firm believer that your physical health is a foundation of your mental health. One of the many reasons I take Athletic Greens AG1 every morning helps me feel and perform my best and not do dumb shit like selling Tesla stock near $100 per share recently. Or maybe it's got nothing at all to do with my health. Maybe it's just that I'm not an idiot. If you're not an idiot, I highly recommend giving Athletic Greens AG1 a go. I absolutely swear by it. Head to athleticgreens.com/SMR. You'll get a 1-year free supply of vitamin D3 and K2 plus 5 travel packs. There's a 90-day money-back guarantee. Athletic Greens AG1 is packed full of vitamins, minerals, and whole food source nutrients, loaded with adaptogens, probiotics, prebiotics, 75 vitamins and minerals. Helps with everything from digestion to gut health to energy and recovery. So click the link in the pinned comment or head to athleticgreens.com/SMR. And just finally, if you guys would like to unlock a load of exclusive content, we're now at 288 exclusive videos and counting fast. You can join Patreon with the card in the corner or the link in the pinned comment, and I'll see you over there. Love ya.